Welcome. Today we're diving into the world of income statements, a crucial financial document for any business. Whether you're a small business owner, a student, or just curious about accounting, understanding how to prepare an income statement is essential. This video will walk you through each step, from gathering your financial data to presenting your final results. By the end, you'll have a clear grasp of the process and be ready to tackle your own income statement with confidence. Let's get started by exploring what an income statement actually is and why it matters for your business or studies. Income statement, sometimes called a profit and loss statement, is a financial report that shows a company's revenues and expenses over a specific period. It helps you see how much money your business made and spent, ultimately revealing your net profit or loss. This document is vital for decision making, as it provides insights into your company's financial health. Investors, managers, and even lenders look at income statements to assess performance and make informed choices. Now, let's break down the main components you'll find in a typical income statement. For preparing your income statement, it's important to understand its key components. These include revenues, cost of goods sold, gross profit, operating expenses, operating income, other income and expenses, and finally net income. Each section plays a specific role in painting a complete picture of your business's financial performance. Knowing what each part means will make the preparation process much smoother. In the next scenes, we'll look at each component in detail, starting with revenues. First step in preparing an income statement is to gather all your revenue data. Revenue, also known as sales or income, is the total amount earned from selling goods or services before any expenses are deducted. Make sure to include all sources of revenue such as product sales, service fees, and any other income streams. Accurate revenue figures are the foundation of a reliable income statement, so double-check your records and ensure nothing is missed. With your revenue data in hand, you're ready to move on to the next step. Next, let's talk about the cost of goods sold, often abbreviated as COGS. This represents the direct costs associated with producing the goods or services you sell, such as raw materials, labor, and manufacturing expenses. Calculating COGS accurately is crucial because it directly affects your gross profit. To find your COGS, gather all invoices, receipts, and payroll records related to production. Subtracting COGS from your total revenue gives you your gross profit, which we'll discuss in the following scene. Gross profit is a key figure on your income statement. It's calculated by subtracting the cost of goods sold from your total revenue. This number shows how much money your business has left after covering the direct costs of production. A healthy gross profit indicates efficient production and pricing strategies. If your gross profit is lower than expected, it may be time to review your costs or pricing. Now that you know your gross profit, let's move on to operating expenses. Operating expenses are the costs required to run your business that aren't directly tied to production. These include rent, utilities, salaries, marketing, and office supplies. List each operating expense clearly and ensure you have supporting documentation for every item. Accurate tracking of operating expenses helps you understand where your money goes and can highlight areas for potential savings. Once you've listed all your operating expenses, you're ready to calculate your operating income. Operating income, sometimes called operating profit, is calculated by subtracting your total operating expenses from your gross profit. This figure shows how much profit your business generates from its core operations, excluding any non-operating income or expenses. A strong operating income means your main business activities are profitable. If this number is low, it may be time to review your expense management or operational efficiency. Next, let's look at other income and expenses. Besides your main business operations, you might have other sources of income or expenses. These can include interest earned, investment gains, or losses from asset sales. Similarly, you might have non-operating expenses like interest payments or one-time charges. List these items separately on your income statement to give a clear picture of your overall financial performance. Including these details ensures your statement is comprehensive and transparent. Net income is the final figure on your income statement and represents your business's bottom line. To calculate net income, subtract all expenses including operating and non-operating from your total revenues. This number tells you whether your business made a profit or a loss during the period. A positive net income means you're in the black, while a negative number indicates a loss. Net income is a key indicator of your business's overall financial health. Once you've completed all the calculations, it's important to review your income statement for accuracy. Double-check all figures, ensure every revenue and expense is included, and verify your math. Reviewing your statement helps catch any errors before sharing it with stakeholders or using it for decision-making. A thorough review also builds confidence in your financial reporting. With a finalized income statement, you're ready to present your results. Presenting your income statement clearly is just as important as preparing it. Use a clean, organized format with clear headings for each section. Highlight key figures like gross profit, operating income, and net income so they stand out. If you're sharing the statement with others, consider adding brief explanations for unusual items or significant changes. A well-presented income statement makes it easier for others to understand your business's financial performance. Preparing an income statement, there are some common mistakes to watch out for. These include missing revenue sources, forgetting certain expenses, or making calculation errors. It's also easy to misclassify items, such as recording a capital expense as an operating expense. Avoid these pitfalls by keeping detailed records, reviewing your work, and understanding each category. Being thorough helps ensure your income statement is accurate and reliable. Accuracy is vital when preparing an income statement. Even small errors can lead to incorrect conclusions about your business's financial health. Accurate statements help you make better decisions, attract investors, and comply with regulations. Take your time, use reliable data sources, and always double-check your work. Remember, your income statement is a reflection of your business's performance, so it's worth the extra effort to get it right. Many businesses use accounting software to prepare their income statements. These tools can automate calculations, reduce errors, and save time. Popular options include QuickBooks, Xero, and FreshBooks. Accounting software often provides templates and step-by-step guidance, making the process easier even for beginners. If you're new to preparing income statements, consider using software to streamline your workflow and ensure accuracy. If you prefer to prepare your income statement manually, organization is key. Start by gathering all your financial documents such as sales records, invoices, and receipts. Use spreadsheets to track each category and perform calculations. Double-check your math and ensure every item is accounted for. Manual preparation gives you a deeper understanding of your finances, but it requires careful attention to detail. There are different formats for income statements, including single-step and multi-step formats. The single-step format groups all revenues together and subtracts all expenses in one step. The multi-step format breaks down the process into sections, such as gross profit and operating income, providing more detail. Choose the format that best suits your business needs and provides the level of detail your audience requires. Single-step income statement is straightforward. It lists all revenues at the top, followed by all expenses. The difference between total revenues and total expenses gives you the net income. This format is simple and easy to understand, making it suitable for small businesses or those with uncomplicated finances. However, it provides less detail than the multi-step format, so consider your audience's needs when choosing. Multi-step income statement provides more detail by breaking down revenues and expenses into sections. It starts with revenues, subtracts cost of goods sold to find gross profit, then lists operating expenses to calculate operating income. Finally, it includes other income and expenses to arrive at net income. This format is useful for larger businesses or those needing more detailed financial analysis. Selecting the right income statement format depends on your business size, complexity, and audience. Small businesses with simple finances may prefer the single-step format for its simplicity. Larger businesses or those needing more analysis often use the multi-step format. Consider who will be reading your statement and what information they need. The right format makes your financial data more useful and accessible. Income statements can cover different periods, such as monthly, quarterly, or annually. The period you choose depends on your reporting needs and business requirements. Monthly statements help track short-term performance, while annual statements provide a big-picture view. Consistency is key. Use the same period for comparisons over time. Clearly state the period covered at the top of your income statement. Comparative income statements show results for multiple periods side by side. This format helps you spot trends, growth, or areas needing improvement. By comparing periods, you can see how revenues, expenses, and profits change over time. This information is valuable for planning and decision-making. When preparing comparative statements, use consistent categories and formats for accurate analysis. Vertical analysis expresses each item on the income statement as a percentage of total revenue. This approach helps you see the relative size of each expense or profit component. For example, you can quickly identify if operating expenses are taking up too much of your revenue. Vertical analysis is useful for comparing your business to industry benchmarks or competitors. Horizontal analysis compares income statement figures across different periods to identify trends and changes. By looking at how revenues, expenses, and profits move over time, you can spot growth patterns or areas of concern. This analysis is especially helpful for long-term planning and strategic decision-making. Use horizontal analysis alongside vertical analysis for a complete financial picture. It's important to understand the difference between an income statement and a balance sheet. While the income statement shows performance over a period, the balance sheet provides a snapshot of your business's financial position at a specific point in time. Both are essential, but they serve different purposes. Together, they give a comprehensive view of your business's finances. Income statement and cash flow statement are both key financial reports, but they focus on different aspects. The income statement tracks revenues and expenses, while the cash flow statement shows actual cash movement in and out of your business. Understanding both helps you manage profitability and liquidity. Use them together for better financial management. Various people use income statements, including business owners, managers, investors, and lenders. Each group looks for different insights, such as profitability, expense control, or investment potential. Preparing a clear and accurate income statement ensures all users can make informed decisions based on your business's financial performance. Income statements aren't just for reporting, they're valuable tools for planning and forecasting. By analyzing past performance, you can set realistic goals, create budgets, and plan for growth. Use your income statement to identify strengths, address weaknesses, and make strategic decisions that drive your business forward. Your income statement is essential for tax reporting. It summarizes your revenues and expenses, helping you calculate taxable income. Accurate statements ensure you pay the correct amount of tax and avoid penalties. Keep detailed records and consult with a tax professional if needed to ensure compliance with tax laws. Investors use income statements to evaluate a company's profitability and growth potential. They look at trends in revenues, expenses, and net income to assess risk and return. A well-prepared income statement can attract investment and support your business's growth plans. Make sure your statement is clear, accurate, and easy to understand. Lenders review income statements to determine a business's ability to repay loans. They focus on net income and expense management to assess financial stability. Providing a detailed and accurate income statement can improve your chances of securing financing. Be prepared to explain any unusual items or significant changes in your statement. Managers use income statements to monitor business performance and make operational decisions. By analyzing revenues and expenses, they can identify areas for improvement, control costs, and set targets. Regularly reviewing income statements helps managers keep the business on track and achieve its goals. Internally, income statements help business owners and managers understand profitability and make informed decisions. They provide a basis for budgeting, forecasting, and evaluating business strategies. Regular internal reviews ensure your business stays financially healthy and competitive. Externally, income statements are shared with investors, lenders, and regulatory agencies. They demonstrate your business's financial performance and compliance with reporting standards. Clear and accurate statements build trust and credibility with external stakeholders, supporting your business's reputation and growth. While income statements are valuable, they have limitations. They don't show cash flow or asset values, and some expenses may be estimated. Income statements also don't account for non-financial factors that affect business performance. Use them alongside other financial reports for a complete understanding of your business's health. To improve the accuracy of your income statement, maintain organized records, use reliable accounting methods, and review your work regularly. Implement internal controls to prevent errors and fraud. Training staff and using accounting software can also enhance accuracy. Accurate statements support better decision-making and business growth. Income statements are often reviewed during audits. Auditors check for accuracy, completeness, and compliance with accounting standards. Preparing accurate and well-documented statements makes the audit process smoother and helps build trust with stakeholders. Keep all supporting documents organized and accessible. Income statements are essential for budgeting. By analyzing past revenues and expenses, you can create realistic budgets for future periods. Use your income statement to set spending limits, allocate resources, and monitor progress. Regularly compare actual results to your budget to stay on track and adjust as needed. Forecasting future performance is easier with accurate income statements. Use historical data to predict future revenues, expenses, and profits. Forecasts help you plan for growth, manage risks, and make informed business decisions. Update your forecasts regularly as new data becomes available. Income statements provide key performance metrics such as gross profit margin, operating margin, and net profit margin. These ratios help you evaluate profitability and efficiency. Track these metrics over time to identify trends and make strategic improvements. Performance metrics are valuable for internal management and external reporting. Comparing your income statement to industry benchmarks helps you gauge your business's performance. Look at key ratios and figures to see how you stack up against competitors. Industry comparisons highlight strengths and reveal areas for improvement, guiding your business strategy. A well-prepared income statement is a key indicator of your business's financial health. It shows whether you're making a profit, controlling expenses, and growing over time. Regularly reviewing your income statement helps you stay proactive and address issues before they become major problems. Income statements support better decision-making by providing clear financial data. Use them to evaluate new opportunities, manage risks, and allocate resources effectively. Reliable income statements give you the confidence to make informed choices that drive your business forward. Follow best practices when preparing your income statement. Use consistent categories, accurate data, and clear formatting. Review your work regularly and seek feedback from professionals if needed. Staying organized and thorough ensures your income statement is a valuable tool for your business. Congratulations, you've learned the essential steps to prepare an income statement, from gathering data to presenting your results. Remember, accuracy and organization are key to creating a reliable statement. Use your income statement to guide business decisions, plan for the future, and communicate your financial performance. Keep practicing and refining your process, and you'll become confident in preparing income statements for any purpose.